It does take us to our talk of the tape, the road ahead for stocks and what could fuel this next leg of this record-setting run. Let's welcome in Greg Branch. He is Branch Global Capital Advisors founder, with me here at Post 9. It's been a minute. It's good to see you again. Welcome back.
Good to be back. Thank you, Scott.
You surprised by where the market is versus what your view has largely been for at least the last year?
I am surprised. I am surprised because fundamentally, some of the things that we were expecting have played out. And so, last you and I sat, we were sitting with a consensus expecting 6 or 7 rate cuts. And now we've gotten down to, in some cases, an expectation of 1 rate cut in some parts of the world. And so I think if you and I had discussed, and to some degree we did, back in February, that the world would come around to a consensus around not 6 or 7, but 1 or 2, and yet we'd still be at these market levels, I think that many would have been surprised back then, and I'm surprised now.
Okay. Economies remain far better than people think or thought it would. That's the principal story. Don't need rate cuts. And earnings have been better than people thought, I think you included.
Agreed.
And that's why we continue to hit records. So what now? What now?
So the things that you cite are actually a part of the problem, or actually part of what keeps me up at night, is that, yes, we saw a 6% earnings growth quarter, but that leads to the question, has the Fed been restrictive enough? And I know that folks have largely disagreed with me on this, and some even thought...
Well, they've been right to disagree with you.
For sure.
Let's be fair.
And the Fed disagrees with me. The Fed has disagreed with me for the better part of the year.
So why are you fighting it?
Am I? We saw in their May 1st notes that we saw 2 unnamed participants said that if current conditions persist, that they would be open to a rate hike. That is the first time we've seen the Fed actually put that back on the table since their pivot on December 13th. And so the preponderance of data that we have, Scott, for 2024, albeit it's weakening more in the last few weeks, but the preponderance of data says that they haven't been restrictive enough to meet their target of 2%.
They've been talking, though, many members think that they're restrictive. I mean, even the Fed chair has alluded to that fact, if not explicitly stated it himself. So why are you still hanging on this idea that they may hike rates?
Because it's not about what they say. It's about largely what they're doing on the pages. And so when we see wage growth move from 90 bips in the fourth quarter to 120 bips in the first quarter, when we see job growth go from the mid-hundreds to 200 and 300,000 numbers, because remember, it was as large as 303,000 as recently as March, and then we see them in the in the SEP move their GDP forecast up, move their forecast for inflation up, and move their forecast for unemployment down, all of those in the wrong direction, it led me to believe what we saw on May 1st, is that the opinion is changing. Maybe not with the unanimity that we saw on December 13th, but certainly there is some changing of opinion among that body.
So you don't think they're going to cut at all this year?
I still don't think that we're going to cut at all. I'd like to wait and see if some of the recent data we have becomes a trend. We've fallen into this trap before, where we've extrapolated what is anomalous data as the new trend. We've seen 20 basis points of core growth a couple of times in the last 16 months before. It didn't end up being the trend. We've seen 170,000 of job growth twice before in the last 16 months. It didn't end up being the trend. And so we'll see what the job data is this week. If we can get to a trend that's in the low hundreds, if we can get to a trend on core inflation that's only 20 basis points, I'll reconsider this view because the data will say that's wrong.